Hello ladies and gentlemen, and welcome to lesson 3 of your foundation trading program. Now my name's Tim Brown, I'm one of the financial trading educators here at the Academy of Financial Trading, and on this webinar we're going to take you through the different ways in which financial traders can analyse the markets. We shall show you the potential problems with each form of analysis, but we'll also share with you our own proven approach to market analysis. Now just to remind you all, this webinar is pre-recorded and will be available to you in your members login area on our website. So just try and sit back and absorb what you can, because you can always go back over these recordings as many times as you like. So if you're ready, let's begin with the webinar. So it's very important for each of you to be fully aware of all of the risks involved in trading the financial markets, especially when trading leveraged products. So please just familiarise yourselves with these inherent risks, and please try to avoid some of the traps that unfortunately most new traders fall into. Now we are here to educate you, and we are here to do everything we possibly can to help you mitigate against those particular risks, and then ultimately profit from financial trading. However, the risks are very real all the same, so please do take a note of our risk warning. So let's have a look at what analysis is. So analysis is the process of breaking a complex topic or substance into smaller parts in order to gain a better understanding of it. So why do we need to use analysis? Well, it's because trading is so broad, it's so diverse, it's so subjective, we must compartmentalize it into manageable chunks. So we've got two major forms of analysis, general analysis. So we've got our predictive and we've got a reactive form of analysis. So let's briefly just look at predictive analysis. Now this is essentially just trying to predict the future movement of a particular instrument based on current facts. So we are going to cover this point in a lot of detail today. There is a note of warning, however. This form of predictive analysis does suffer from several flaws. Firstly, it makes the assumption that complex interconnected variables will both remain static and that no new supervening events will occur. This is the assumption that predictive analysis makes. So let's look at the collapse of Lehman Brothers as a very, very good example for me to explain this in a bit more detail. Now, it essentially caused a worldwide credit crunch. Now, it actually received a AAA rating the very day before the bank went under. So you can imagine what would have happened if you bought Lehman stock the day before it crashed, based on this preconceived idea of predictive analysis. So that is fundamentally the problem with trying to be predictive when analysing the markets. Now, in addition to predictive, we've got reactive forms of analysis. Now, this is essentially reacting to the past. So usually it's more clean cut in terms of ultimate decisions made. It's still based on the past. So it's better to gauge from the past and trade based on probabilities than to actively assume a market is underpriced or overpriced, particularly for the new trader. So again, predictive or reactive analysis, both of these absolutely do have their weaknesses, but we would argue that predictive analysis places far too much expectation on the experienced. This often results in too much personal damnation, taking on board a whole range of psychological factors. So, which in turn, this has a huge knock-on effect from this sort of psychological perspective, which can then have disastrous implication on one's risk management. So, let's have a look at the differences now between what we would call a trader and what we would call an investor, because they're clearly two different things. So if you are a trader buying a stock, you are buying because you sense a price movement for whatever reason, through perhaps technical analysis or market sector news or so forth and so forth. So you are essentially interested in profiting from that price movement only. And you will then look to sell that stock and then move on to another stock. So you don't have much sort of emotional attachment to what you're doing. So you have no real interest in the company behind the stock other than trading that particular stock at the right time and hopefully at the right price. So in addition to our traders, we've also got our investors. Now, they look to invest in a company. So you have then done a thorough analysis of the company and believe that that company has long-term growth potential. You then understand what the company does and you understand what its position is in the market. Now, if the price then drops, you know why, or you can determine whether this is actually a short-term situation or perhaps a change that can have a long-term effect on the actual price of the stock. So you're in a much more informed position about the inner mechanics of that particular company that you're investing in. So in simple, guys, a person who buys a stock is more precisely a trader, while a person who invests in a company is referred to as an investor. So it's very important to make those two distinctions. As long as the stock price is performing well, neither the trader nor the investor will have much of a problem because they'll be earning money, so everyone will be happy. However, when the stock price starts to fall, the smart trader has an escape plan to prevent small losses from becoming huge losses. So the trader has no emotional attachment to the stock whatsoever. So they get rid of their losers easily. Many traders find that getting rid of a stock when it has fallen a small amount a very good way to keep losses small. So the problem arises when the trader decides that they like the stock and they don't want to give it up easily. They become emotionally attached to that stock. So they've stopped now being traders and they've now switching their mindset to becoming investors. The problem is they usually don't know enough about the company at that particular point to make proper, informed, intelligent decisions about whether to hold the stock or to let it go. So they are no longer smart traders and they're not even smart investors. So they're in between the two. So they're essentially going to lose money. So any decision they make as an investor at this point will be purely guesswork. So the investor is probably better off when things go bad, but only if their convictions are followed through. So if the stock price drops, he or she reassesses the company and the market in which that company operates. So has something changed, or is now the time to perhaps add to your holdings? So when the price drops off, they might look to buy again into that market. So if they become a trader at this particular point, they are likely to fail. So they should not jump on the sell at small stop loss rule if they truly believe in the company's long-term potential. So we're talking about sort of nerves and convictions when you're talking about being an investor and fully understanding and knowing exactly what you're doing. So the conclusion, guys, or the moral of this particular story is that it is okay to be either a trader or an investor. Just do not try to be both with the same market that you are looking to speculate on. So I hope that just breaks down the difference between a trader and an investor for you. So now let's look at the three different forms of analysis. So let's start with fundamental analysis. Now this is simply the study of the underlying economic conditions. So for example, it's looking at news, politics and reports. These reports could be either scheduled or unscheduled. We're talking about financial statements, strengths and weaknesses of companies or sectors or economies or regions. So this attempts to gauge the overall well-being of a market. So in addition to fundamental analysis, we've also got technical analysis. Now this is essentially just studying price action and charts. We find it incredibly clear-cut. This is our proven method of analysis. This is what we like to use here at the Academy of Financial Trading. It has much greater objectivity when done in a reactive manner. So we will explore this in much greater detail in a couple of lessons' time. So in addition to the fundamental and technical analysis, we've also got market sentiment as a form of analysis. Now this is the shorter term feel of the market. So for example, fundamentals could be positive, but technicals and market sentiment might be negative, which could be seen through the price action on a chart. So for example, it could be seen as a reversal or a pullback on a price chart. So this can often be driven by market news releases. So price action often then continues moving to the upside on positive market sentiment and technicals. So those are the three different types of analysis, a very quick snapshot and overview of how you can analyze the financial markets. So here is a statement now, guys, for you to consider. Markets do not act rationally. And guess what? I'm pretty certain that most of you do not act rationally either. So let me explain what I mean. In fact, let me actually put it to the test. Let's see how rational you really are. So a shopkeeper sells a can of cola and a lollipop for a combined cost of £1.10. So there's your £1.10 figure. Now, if the shopkeeper is selling a can of Coke for £1 more than the lollipop, how much is the lollipop? So how much is the lollipop if the total amount paid is £1.10? If we know that the can of cola is £1 more than the lollipop, so how much is the lollipop? It's quite a straightforward calculation. Let's see if you got it right. So it does seem like a very simple calculation to make, but if you said the lollipop cost 10p, you would be wrong. Now, please don't worry, most people do happen to get this wrong. So the lollipop, when you think about it again, it has to cost 5p. So therefore the can of cola would be worth £1 5p. You add those two together and you get your £1.10 figure. So look, congratulations guys if you wanted a few that did get that calculation correct. Now let's apply this to fundamental calculations, which are essentially so much more complicated and involve constantly moving parts than this very simple calculation could ever achieve. So in addition to that, we've got people, economists, news broadcasters, analysts that like to talk about these types of things, but we know get it wrong an awful lot of the time. So otherwise we wouldn't get stock market crashes, for example. No one would see those coming. So a famous quote by George Bernard Shaw simply states that if all the economists were laid end to end, they'd never reach a conclusion. So after this particular example, let me ask you now, do you think it would be wise to trade on your initial gut or initial sentiment in the markets? Just going on the back of sort of making decisions on what you think you know. So that's a good question for you to consider. Surely, guys, it's much better to react once a certain set of facts have actually presented themselves and then look to trade it accordingly. Now, this is the approach we take here at the Academy of Financial Trading. Every other method requires subjectivity and opinion. This to us is just too dangerous, too difficult, and it's too unstable to try and trade profitably using those methods. So this is just something to acknowledge. We will come back to this a lot later in the session. So let's have a look at fundamental analysis in a bit more detail. So here's a definition from Investopedia. Now, please note that I have simply highlighted the word value a number of times in this definition. So fundamental analysis is about using real data to evaluate a security's value. Now, the main basis for fundamental analysis is simply supply and demand. So let me ask you all a few questions. Think of a figure in terms of how much you would pay for an apple, one apple in your local market. Now, what if you saw fantastic quality apples being sold down your local market for 1p or 1 cent per apple? What are you thinking? So you initially had a figure in your head, hopefully, but now you see these apples being sold for 1 cent an apple. What are you thinking? Or 1p an apple? What's going through your head? I'm sure you would be delighted. You'd think the price point is incredibly cheap. You might actually go ahead and buy a load of apples because it's such amazing value. So in effect, as a result of this very cheap price, demand increases. Because of this demand, what is likely to happen to the price of those apples? So over time, I'm sure you'll all agree that the price of these apples are probably likely to increase, and it's basically because of this increased demand. So now further down your local market, you see another stall, and they are also selling fruit, except this time you see the same quality apples, except this time they're being sold for £1 an apple, or $1 or €1 an apple. What are you thinking this time? So you've just seen the very, very cheap apples. Now you're seeing, which I'm sure you would regard as being apples which are very overpriced. They're too expensive, they're not worth it. So what do you think would happen to demand at this point? Well, not as many would be sold, you would assume. Why would they? So now, what is the likeliest impact on price if demand decreases? Now, I'm sure you're all getting the very gist of what I'm saying. The price is likely to reduce in order for the guy who's selling those apples to sell more apples. So if demand is greater than supply, will that lead to higher prices or lower prices with all other things being equal? So just give that some thought for a split second. What we're saying is, if demand is greater than supply, it leads to higher prices. However, if supply is greater than demand, it leads to lower prices. So we shall talk about this in a lot more detail later on in this particular lesson. So this is a very, very crude example of what fundamental analysis looks to do. It uses complex, ever-moving calculations to try and gauge value in a marketplace. Now, these traders will look to buy perceived undervalued assets, and they will look to sell perceived overpriced assets. This is what they do. So I hope this does make sense for everyone. I hope you get the basic principle. So fundamental analysis is often regarded as being completely opposite to technical analysis. Now, we don't happen to agree with this statement entirely. We believe it absolutely is important to have a basic understanding of both. However, we do believe it's hugely important or advantageous to focus on one type of analysis. So you will see as we go exactly why this is the case. Over the next few slides, I'm going to get quite technical. It is a little bit heavy, I do appreciate that. It's a little bit complicated, but please do bear with me because this is still very important information for you to know. The reason why it's important for you to know is because half of the professional traders out there use these types of techniques. So just try and stick with me. So what I would like to show you is one of the most common valuation techniques used by analysts to value a company or stock. So let's have a look at price earnings ratio. Now, you often hear on Bloomberg, they interview fundamental analysts and they talk about the PE ratios when discussing valuers and stock prices. So let's take a look at this particular method of valuation and see how it's calculated. So the basic equation is market value per share divided by what's called the EPS, which is the earnings per share figure. Now, the earnings per share part of this equation involves quite a bit of work. So the basic calculation is net income minus dividends on preferred stocks divided by average outstanding shares. Now, to get the net sales part of this equation, it involves a lot more work. So we're talking about net sales. So this is sales minus returns, allowances for damages and discounts, and we minus the cost of goods sold. So this is the cost to produce goods, including materials and direct labor. Now that will give you what's called your gross profit. So once we have our gross profit, we then need to minus our expenses, and this is our earnings. This is our EBITDA, which is EBITDA. So this is essentially earnings before interest, tax, depreciation, and amortization. So now earnings is the amount of profit that a company produces during a specific period. So, which is usually quarterly. This is 3 calendar months, or it can be an annual figure. So earnings typically refer to after-tax net income. So ultimately, a business's earnings are the main determinant of its share price. So because essentially earnings and the circumstances relating to earnings can indicate whether the business will be profitable and successful in the long run. So I hope this kind of makes sense. Now, the final part of this earnings per share figure is earnings minus interest, tax, depreciation and amortization, which will then give you your net income figure. So it's quite a convoluted way of coming up, but this is the whole issue with fundamental analysis. It involves a lot of work. So now we have our net income minus preferred our dividends. Now these are essentially the privileged few who essentially get paid before the common share dividends, aka the rest of us, get paid. And then we divide this figure by the average outstanding shares, which in itself is an incredibly complicated figure to work out. So I really do appreciate, guys, that this is very complicated stuff. It is this price-earnings ratio which analysts use to determine value. This is the whole point of this particular slide. So to make things even more complicated, different analysts actually use different calculations. So as you can see, it's very heavy work. And at the end of all your calculation, there is a possibility of you still being wrong. So this is the whole problem with it. So hopefully this just gives you guys a breakdown of the process of valuing a stock using the term price earnings ratio, just as a brief example. So let's just move on for now then, guys. So if I was looking to value a company, what else would I need to look at? Well, I've identified three major factors to be considered. So these are, I would need to look at growth characteristics of the stock that I was looking at. I'd also need to do a comprehensive risk profile, and I'd need to assess its quality of earnings. So let's have a look at growth characteristics to begin with. Now, organic growth is this concept of organic versus acquisition or debt-driven growth, because there is a difference between the two, but organic growth is fundamentally key to success, in our opinion. In a McKinsey Consultants report, which was published a few years back, it did show that 70% of major deals were actually destroyed value for their shareholders. Now, organic growth comes from being good at something. It is an outcome and it is not an end. So let's take Apple and Steve Jobs, for example, where innovation and great products was absolutely everything. Now, they were supremely focused on execution. They were focusing on meeting a need and then offering value to customers. And as a result, they increased their market share and are now one of the biggest companies in the world. So think about for a second what a share is. Now, a share is simply your right or your percentage of the competitive position of the company in which you are investing. So an example is GM over the last 20, 30 years. They've not stayed particularly competitive. As a result, they have seen a steady decline in their share price. So organic growth is actually critical to, it's critical with acquisition debt-fueled growth being viewed as essentially being too risky an option to take. So in addition to that, we'd need to consider what characteristics growth are we looking for. So this is essentially looking at earnings versus cash flow. Now, cash is essentially king in this respect. It's harder, but not impossible for a company to manipulate its cash balances. However, some companies can include earnings based on contracts for sales that may not materialize. So this is something to be aware of, guys. So in addition, we've also got what's called scalability. Now, this is a service that can be replicated easily without extra capital, with the goods generating recurring sales. So just for example, on the whole scalability model, let's have a quick look at Amazon for an example. Now, Amazon during the 90s, they essentially needed 2 days worth of stock versus a company called Barnes & Nobles, who were essentially its competitor at the time, needing 4 to 5 months worth of stock. However, Amazon used what we call today the World Wide Web, and they used this to help support its worldwide distribution, whereas Barnes & Noble at the time didn't. They weren't so interested in scalability as such. So now look how big Amazon actually are. They're highly scalable organization. So the idea is to build something once, use it often, and then look to sell it many times. So it's quite a basic principle, but it's a very important one. So let's now talk about risk, our risk profile. So what are we talking about this time? We're talking about business risk. We're talking about risk from competitors and suppliers and customers. So, but we're also talking about things like your environment, your regulatory environment, your location, economics, and a whole range of other sort of associated risks. So business risks are very important indeed, but also our financial risks. So this is like things like your debt and the amount of interest that you pay on your debt. So we're talking about things like gearing, we're talking about leverage and debt and cash. So if your operating profits divided by your interest payable is getting close to a figure of an industry accepted figure of 2, then this is a very high proportion of interest to pay in relation to your operating profits. So essentially the company is paying too much interest on its banking debts, for example. So this is something to be aware of when looking to value the company. So in addition to business and financial, we've also got reputational risk. Now, we're talking about management. We're talking about who is driving the ship. You know, this is something that Warren Buffett is very concerned about, or he looks for when he's looking to invest in a company. Now, it's essentially about having a proven track record in driving the company forward. That is something that is of real interest to a huge investor like Warren Buffett, for example. So we've got our growth characteristics and we've had a quick look through risk profiling. We also need to look at quality of earnings. So now we're talking about predictability. So I'm sure you're saying predictability about what? Well, we're talking about revenue. How predictable is your revenue? How predictable is your pricing power? You know, do they operate in a stable market? How long term are the contracts that they have? How long are they in place for? Good diversified revenue streams, for example. These are sort of issues related to predictability. How predictable are the company in terms of what they do and how they conduct themselves? So we've also got, does earnings, or the earnings per share, turn into cash? So we discussed this earlier. This is very important to know because we know that cash is king. And also it's very important to assess quality of earnings by looking through their accounts. So it's very straightforward to go through the reconciliation of operating cash in the accounts. Now this is required by law by every single company, so all the information is out there and readily acceptable. Okay, so hopefully that just gives you a breakdown of the things that you would need to do in order to value a company in a bit more detail. Right, so this is not all, however. I do want to show you all of the other methods of valuing a company. So we've only looked at the tip of the iceberg. So let me just call out a few different other methods of valuing stocks. So one method is profit margin, which is net income divided by revenue. We've also got book value. We've got dividend yields. We have got PB ratios, which are essentially your share price divided by your book value. We've got free cash flow. We've got return on investment, or your return on your equity or assets. Now, you simply get your net income figure and you divide this by your investment or the equity or assets that you hold. So you can use industry analysis, you can use debt equity ratios, you can look at working capital. As you can see, a whole range of different methods of valuation. You could look at growth. Now this is a very interesting one. Benjamin Graham. I don't know if any of you have heard of him, but he wrote The Intelligent Investor. Now he essentially taught Warren Buffett back in Columbia University, so he is someone worth paying attention to. Now this is his own calculation to value a high growth company, and it was simply current normal earnings times 8.5 plus twice the expected growth rate. Again, on Bloomberg, you will see people being interviewed looking at 8.5 times the expected growth rate. So this is probably where they got this sort of calculation from. So it is so difficult to value a company properly. This is the point we're trying to make. So you can see the various different types of methods of valuation. It would really help to be some sort of mathematical genius, or perhaps even being a fully qualified and certified accountant. That would go some way to helping you achieve success in terms of valuing companies in these ways. But unfortunately, this is not the case for most of us. So I hope everyone is still with me. I appreciate that I'm being very ambitious and being incredibly optimistic with this particular lesson. I am cramming essentially a year's worth of study into a 1-hour webinar. So please do bear with me. It's just really important to give you a general feel for what's involved in fundamental analysis. Okay, good guys. So in that case, let's move on at this particular point. So now let's talk about some different asset classes. Let's talk about commodities. What are commodities? So commodities, for those of you that don't know, is essentially anything that can be pulled out of the ground that is traded on an exchange. So what we're talking about here is your energy commodities such as oil and natural gas. You've also got metal commodities like your gold or your copper. You've also got agricultural commodities like wheat or corn, and you have your soft commodities like soybeans and coffee, etc. So the main basis for commodity fundamental analysis is simply supply and demand. Now, price movements in commodities using fundamental analysis can be broken down into this very simple formula, which we actually discussed earlier. Now, very basically, if demand is greater than supply, it leads to higher prices. However, if supply is greater than demand, it leads to lower prices. So this is something for you to be very aware of. Now, commodities also do trade in cycles. Sometimes supplies will be tight and prices may be high as a result. Other times we have too much of a certain commodity and prices fall accordingly. So the supply of a commodity is the amount that is carried over from previous years of production and the amount that is being produced during the current year. Now, the demand for commodities, is the amount that is consumed at a given price level. So the rule of thumb is that demand will increase when the price of a commodity moves lower. Oppositely, demand will decrease when the price of a commodity increases. So there is an old saying amongst commodity traders that low prices cure low prices. So this means that more of a commodity will be consumed at lower prices, which lowers the supply, and thus prices will eventually start to increase. This is all this particular phrase actually means. So in addition, we have also got to take on board weather, factors that affect the weather. So this can also have an impact on the supply of a certain commodity. Now, bad weather means essentially less soybeans, less coffee, less wheat, less corn crops, etc. So what does this actually mean, or what impact will this have on the price of that commodity? So if the demand is greater than the supply in this particular example, prices increase. So you also need to consider things like crop planting, production and stocks. So this is your production and corn reports, etc. Now, there are several reports from the US Department of Agriculture that are helpful in your research and trading of corn futures and options. So, for example, we've got our prospective plantings, which is the first main report at the beginning of the corn growing season. Now, this is released around the end of March. Normally, it summarizes exactly how much and which crops the farmers expect to plant for the upcoming season. This is all that this corn growing season report, or prospective plantings report, will actually show. So in addition, you've also got monthly crop production. Now, this is released around the 10th of each month. This report gives you an updated estimate of supply and demand for things like corn. So we've also got to consider grain stocks. Now, This essentially provides information on the current supply of corn and other grains in the US and around the world. And these are the websites which you can use to get all of this very, very valuable information. So if trading commodities, you also have to consider the inputs of technology, or the impact that new technology can have on the supply of a certain commodity, which will then in turn affect the price. So as technology increases, you would imagine it has a direct impact on the ability to harvest a certain commodity. And then as a result, if more is supplied, it then has effect on the price. So exactly the same thing applies to labor costs or labor conditions. So if you can imagine, if a gold mine in some part of the world actually becomes unionized in a particular country, then that can directly affect the supply of gold in that country, which can then have an impact on the price of gold if the supply begins to dry up as a result of these labor conditions, or the unionization of its labor force. So I hope that just gives you a real good sort of breakdown in terms of fundamental inputs when looking at commodities. So now let's have a look at the same inputs for currencies. Now, it's notoriously difficult to value a currency because of its size, being such a macro instrument, but also because it has so many constantly moving parts. But if you step back and you essentially take a holistic approach, the fundamental inputs are similar to that of trading stocks. So how would you begin to value a currency? Just quickly sort of hazard a guess in your own heads, what sort of things would we now need to be looking at if we're going to try to determine value of a certain currency? So let's now just have a little look through those essential reasons. So firstly, you've got things like growth. So growth can impact the perceived value of a currency. So now we're talking about things like interest rates and inflation, things like your goods orders, your manufacturing and your services surveys. So it's all these growth related indicators. So in addition to growth, we've also got financial risks can affect the value of a currency. So we're talking about trade balances and national debt and political stability and employment data. And then in addition to financial risks, we've also got earnings. That can also affect the value of currencies. So we're talking about now your GDP figures, your gross domestic product figures, your production, your retail and your home sales. So believe it or not, it's actually easier and much more straightforward to fundamentally analyze stocks than it is to fundamentally analyze a whole currency. So I'm sure you can see from the last few slides that there is some very fundamental problems with fundamental analysis for retail traders like you and me. So to add to that complication, here's a few more fundamental problems that you may experience. So we've got different analysts use different fundamental measurements. So this is when I was talking about our price to earnings ratio, and when we go through the calculations, different analysts use different input figures to work from, so they can come out with slightly different results. So in addition to that, everything is magnified for these macros or these composites. So that's another major problem when trying to fundamentally analyze these types of asset classes. So based upon various input information actually being correct, so often, or more often than not, you might actually get incorrect information to start with. So another potential problem is that you're up against all the quantitative analysts, the insiders and the traders who have significantly more resources at their disposal than you and me will ever have. So there's a lot of information that you'll probably never get access to. So with all this in mind, guys, can we just simply ignore fundamental analysis completely? Well, the answer to this question is categorically no. But let me explain to you exactly why this is the case. Well, the reason is that fundamental analysis impacts on all styles of trading, especially during major news announcements. Now, there is a lot of poor information, or perhaps maybe disinformation out there on the web, but there is also some great free available nuggets of information and websites out there to be used. Now, forexfactory.com is one of those websites that we use ourselves here. So do have a look at that in a little bit more detail in your own time. It has all the major news announcements with the figures the market expects to come out, the actual figures as they come out, and it also gives you other information like historical graphical deviations between expected and actual figures for all major scheduled news. So you do get quite a lot of very, very useful information from this one site in this one location. So we have absolutely no relationship whatsoever with forexfactory.com. Now, it's just a great resource to use. So we recommend you having a look at that. Now, we will also show you this website in a little bit more detail during lesson 7, and it will show you how to access other great resources like Audio Squawks, which is essentially just a live audio feed. So you can listen to these news announcements as they happen. That's what the beauty of these live audio feeds are. So now, the main currency-related announcements you will see on Forex Factory would include news releases like your GDP figures, your interest rates, your inflation, your production figures, and employment figures. However, this is not all. There are many, many more. We've also got other major news announcements like wars and natural disasters. We've also got inflation and interest rates. Now, these include the precursor like your CPI and your PPIs, which are essentially your consumer price index and your producer price index. But we've also got US Federal Reserve meetings and guidance, and they have big impacts. You've also got payroll and employment figures. You've also got things like home sales and production. And you've also got balance of payments and trade balance. Now, you've got your retail sales, which are essentially aggregates of all sales that you and me purchase on a daily basis. And we've got our PMI figures. In most countries, except the US, these figures are actually released by a company called Markit.com. That's MARKIT.com. Again, a very useful resource, guys, indeed. It is possible to get the PMI figures released 2 minutes before the rest of the market receives them. Now, we'll explain this in a little bit more detail during lesson 7. So now let me show you guys the impact that these news announcements can have on the financial markets. Now, we don't have time to go through too many, but you will get the general gist of what we're trying to say. Now, we'll start with our gross domestic product, which is our GDP figures. Now, let's firstly go through what GDP is. It's the value of all goods and services a state produces. So we're talking about measuring the size of an economy. Now, GDP is simply calculated as follows. It's looking at your consumer spending, how much you and me spend on a daily basis. And then we need to add government spending, how much our government spends on an annual basis. And then we need to add business investment. How much does the business community spend on investment and capital spending? And then we need to add on net exports as an economy. So that's exports minus imports. So GDP is essentially a very crude way of reflecting on the standard of living of each country. Now, through your GDP per capita figure, which is essentially your GDP divided by the number of people in a country. It's a crude method, but very useful if you're looking to compare country by country. But the problem is with this GDP per capita figure is that we all know that wealth is not shared equally. So it does have its limitations. So that's just something for you to be aware of. But let's see what impact this has on the market. So then we go to Forex Factory. This is a page from Forex Factory where we can quite clearly see there is a GDP news announcement from the British pound, or about the British pound, should I say, on Friday, January the 25th. And as you can see, it also gives you the time in which the news will be released, which is 9:30. So if I take you over to the right-hand side of this square, you can actually see what the figure was when this news was released in the previous quarter. So in the previous quarter, when this figure was released, it was 0.9%. Now, the middle column, which is your minus 0.1%, is what all the analysts combined did all their calculations, and they said, yep, the GDP figure should come in at minus 0.1%. This is what we were predicting. However, on the left-hand side of those three figures, we've got a release at 9:30 a.m. on Friday the 25th of January. The figure came out at minus 0.3% for our British pound prelim GDP figure quarter on quarter. So you do get all the information you need from each news release, and as you can see, it's got a red sort of factory sign, which means it's high impact news. So let me show you exactly what impact this had on the financial markets. So let's go over to our British pound, and as you can see, when that news was released, in the space of 4 minutes, we saw a 60 pip move in little under 4 minutes. So that just gives you a little taste of what can happen. This is the impact that these news releases can have on everyone's style of financial trading. So let's have a look at another example. This is again a British pound. It's going to affect the British pound, and it's again another prelim GDP figure quarter on quarter. And as we can see, we've got the date, which is Thursday the 25th of April, and again at 9:30 a.m. release. So if I take you over to the right hand side of that box, we have got the previous figure. The last quarter, the release, GDP release, was minus 0.3%. All the analysts forecasted an improved figure of 0.1%. However, when the actual figure was released, it was an improvement on that at 0.3%. So let's see what impact that had on the market. As you can see, it had a huge impact. The market wasn't expecting that news to be released, and as a result, we saw over 130 pip move in 3 minutes. So now let's show you another example. Let's have a quick look at inflation. Now, inflation is simply an increase in prices of goods or services over time. This is when essentially a loaf of bread might cost you £1 last year, and now it costs you £1.20 this year. This is essentially inflation in action. So when you think about it, when inflation or prices go up with the same amount of goods and services in a country, it basically means that the residents of that jurisdiction have less purchasing power because their currency is then worth a little bit less. I hope that sort of begins to make some sense. I know it sounds ridiculous, but it does make sense when you think about it. So governments also try to curb this inflation through what's called fiscal and monetary policy, but primarily monetary policy by either deciding to print more money or less money and changing the interest rates accordingly as a result. So if you increase interest rates, you essentially curb inflation and you make a currency more valuable, which is what us traders look for in the market. So let's just ask ourselves, why is this the case? Why do governments not simply have just massive interest rates? Well, in order to answer this very important question, we need to just take a very brief step back. Now, it is absolutely accepted that when interest rates are low, that this, as a consequence, encourages spending. But when interest rates are high, it encourages saving. Now, please do give this some thought for a minute. So can you see that essentially too much of either can be a bad thing for an economy? It's much better for an economy to have a balance between spending and saving. If the interest rates are too low, this leads to increased spending. But if it goes unchecked, it can actually perpetuate what's called hyperinflation. Now, we've seen a form of hyperinflation in the recent global property market bubble, for example. Now, the world's first recorded example of hyperinflation actually came during the French Revolution, where monthly inflation actually peaked at 143%. So this is essentially you paying £1 for your loaf of bread last month, and this month you're now paying £2.43. And in 3 months' time, at this particular rate of 143%, this same loaf of bread might actually cost you £16 for that same loaf of bread. So can you see how very dangerous hyperinflation can be to an economy? If you do want to read up on hyperinflation, you can look at Germany in the 1920s and more recently Zimbabwe in 2008-2009. So arguably a major contributing factor to the global housing bubble was probably easy access to cheap funds. which saw huge increases in global property prices for all of us to see and experience. So if interest rates are too high, people stop spending and they start saving. And this is also not good for things like job and economic growth. So central banks essentially, guys, have an incredibly important task in order to manage inflation. And they do this using interest rates as a tool to achieve this. So what does this mean for us traders? Well, any sniff of an increase in increased rates by a central bank will essentially mean that the value of its currency will also increase as traders and investors look to move its money to get a better return. So demand for that currency increases, so price as a result also increases. Now, let's just see what impact one of these interest rate announcements can have on the market. So here we can see the ECB cut interest rates by 25 basis points. So we can see that previously the announcement was 0.5%. All the forecasters and the analysts said that the ECB were going to keep their rate at 0.5, and lo and behold, when the actual figure was released, it was 0.25%. So now let's just see what impact that had on, for example, the euro dollar. So when we go to the euro dollar chart, we saw a 115 pip move in 5 minute flat. So that's exactly what can happen when these kind of news releases are released. So to show you another example, on September the 18th, 2013, the then Federal Reserve Chairman Ben Bernanke was expected to taper the US government's 85 billion US dollar asset purchase program by 10 to 15 billion. Unfortunately, this didn't happen, so let's see the impact on this particular taper surprise and the impact that this had on the market. That was what was expected, and this is more of a reverse response to something not happening in the market. So let's see what impact that actually had. So on this 5 minute euro dollar chart, we saw a 110 pip move in 15 minutes flat, with another 60 pip run over the next couple of hours. So they did actually, for those of you who are interested, finally start the taper, but they tapered by 10 billion on December the 18th, 2013. So some 3 or 4 months later. So that's another example in terms of the impact that these things can have on the financial markets. Okay, good guys. So let me show you one more as an example. So as well as the Fed, the US government and politics in general can have a massive impact on the financial markets. So let me show you this S&P 500 chart. Now, some of you may remember back in October 2013 that the US federal government was in partial shutdown. Now, this was due to a disagreement over government fiscal spending. Now, an 11th hour deal actually was finally brokered on the 16th of October, which effectively saved the US from going into an unprecedented debt default. Now, the current US debt is in excess of a massive 17 trillion US dollars. So that is essentially 17,300 billion dollars. This is a mind-blowing amount. This amount of debt adds up to 57,000 US dollars per every US citizen. That's every man, woman, and child in the US. So if you count only those who actually pay tax in the US, the amount per capita actually triples to over 170 US dollars. Now, would you believe me if I told you that all of a sudden that this debt limit actually no longer exists? That's right, completely and utterly gone. Between then and February 2014, the US federal government agreed for it to spend as much money as it likes. So sky's the limit in terms of spending. So what essentially does that mean for us? It essentially means a lot more cash is swishing around the system, probably propping up things like the stock market, which we've seen in recent years. So on this 5 minute S&P chart, we saw a move of over 100,000 points in under 2 hours. So an incredible move. So all of these examples just give you a feel for how important these fundamental economic news releases actually are and how they impact on the financial markets. The point I was supposed to make is that it is important to have some understanding of market fundamentals. However, like I've said, we trade technicals, which is a very different form of analysis. But certainly having a basic understanding will absolutely put you in good stead. Okay, so now let me talk a little bit about what's called market sentiment as a form of analysis. So it's not directly tradable, but it will develop your knowledge and understanding and perhaps satisfy your curiosity as to why certain things happen in the financial market at certain times. So you may have heard of the term risk on and risk off, but what exactly do they mean? So we now know that markets are steered by fundamentals, but they are near impossible to measure. That's the important aspect. Now, the good news is that we have a solution because we can absolutely measure this through what's called technical analysis. So this is what we do here. This is our approach to trading successfully the financial markets. And this is what we will essentially show you over the next couple of lessons. So it is important to note that different markets do have different appetites towards risk. So this can often be seen through the price action of a particular market, whether price is moving to the upside or to the downside. So we must also be aware as to what state the markets are in. Now, this is the problem with looking exclusively at the smaller timescales. It's almost impossible to see the bigger picture. So you must zoom out and be aware of what state the markets are in by looking at much bigger time frames. It will give you a much clearer interpretation in terms of what's happening. So, are they trending? These are the sorts of questions you need to ask yourself. Or are the markets reversing? Or are they consolidating or ranging? This is really your starting point, which we will explain to you in much more detail over the coming lessons in terms of exactly what we mean by this. So, with risk on, people and markets in general have a much bigger appetite for risk. Risk on is when confidence is high, sentiment is positive, and the markets are bullish. So how do we know this apart from anecdotal sound bites from perhaps your Bloomberg or whatever news channel you're listening to? Well, we can see it through physical charts, i.e. we can see where people, where speculators, where hedge funds, where investors, we can see where they put their money. Now, this is what is very, very interesting to us, and this is how we make our money. So what we need to ask ourselves is, are the major markets rising or falling? And which markets do people want to trade when they want to take on more risks? This is just a very common sense question to ask yourself. Well, the answer is categorically the stock market. That's our composites, our indices, which are just like I've already discussed in lesson 1 and 2. These are simply baskets of shares and equities. So these are riskier assets because you don't get a guaranteed return. You can't guarantee the performance of any particular company. So a way of analysing risk on and risk off and the general sort of risk appetite of the market is whether the indices are up. If the S&P is up, if the FTSE is up, if the DAX is up, etc., etc. Now the way to think of this is that it is basically a quick bill of health for risk on versus risk off in the market. So let me show you what this happens to look like on a chart. So we're now looking at a daily S&P 500 chart. So we can see when investors' confidence is up, when there is a period of risk on. Now the risk on phase is simply when the market is trending upwards. This is the only important aspect to get your head round when we're talking about market sentiment and a topic like risk on. So in these phases, we're very much in a risk on phase. So the opposite of risk on is, of course, risk off. So risk off is when people are essentially fearful of the underlying economic conditions. So this is when investors are in fear. They do not typically want to trade equities and would rather trade safer instruments. So this is typically caused by negative macro events like sovereign debt fears, or the risk of a default occurring. So for instance, back in October 2011, Eurozone ministers indicated that Greece bondholders may have to take much bigger losses on their debt. As a result, the markets became very fearful. There was an aspect of risk off in the market. So what sort of assets would people look to buy when they are terrified of economic conditions? Some of you may know this already. They look to commodities. They look to things like gold or sovereign bonds or commodity-rich currencies such as the Swiss franc or the Australian dollar. So they can, in some instances, look to the US, which is seen as a global currency. For those of you that remember, when Lehman's Bank fell in 2008, people were surprised when the dollar started to increase in value. But if you think about it very calmly and rationally, if you own a massive amount of US shares, what do you get in return for them when you decide to offload or sell them? Of course, you get dollars. So demand for US dollar actually increased as a result of dollar strengthening. So the same thing actually happened in Japan during the Fukushima crisis. So in crisis times, people or investors become very, very fearful. So they essentially take their money out of stocks and they look for what's called safe havens. Like I said, like gold or the Swiss franc or the US dollar. Hence, being in a state of risk off. So let me show you now what this looks like on a chart. So during phases of risk off, we would see phases like you can see on the chart now. So it's basically when the S&P moves to the downside. So looking at this S&P 500 chart, we can clearly see when investors' confidence is down, when there is a period of risk off. So as you can see, the general trend of the S&P in general is risk on, but with visible phases of risk off. This is when price simply trends to the downside as a result. Now, if you see this occurring on a major indices, you will then know that it will have knock-on effects across other different sorts of asset classes. So it just gives you a head up in terms of what phase the market is in. So to wrap up this S&P daily chart, guys, you can all see that the sentiment is clearly risk on, which is essentially price is consistently moving to the upside. What you must remain focused on is whatever market you trade, you will always see what's called things like pullbacks, even on the most trending of markets. So what we find with these trending markets is that the most inexperienced investors often enter in the latter parts of a cycle, essentially paying for the gains of those who entered in the earlier parts of this particular cycle. So this can equally apply to your own domestic housing market, anything where large numbers of inexperienced investors are likely to be drawn to the latter part of a cycle. The recent fall off in the Chinese Shanghai Composite is a very, very good example of the carnage that can occur when people get caught up and essentially the markets take a 30 to 40% dip. So the rule is when everyone who would or could invest has already invested, then a market simply can go no further because there are no new participants willing to pay those higher prices, so or lower prices for that particular matter. Then that market has to tumble to a price point where it begins to meet demand once more. This is essentially the fundamentals. This is what essentially happens. So we now also live in a society where information spreads remarkably quickly. So we must be conscious of this fact and understand that things can move very, very quickly indeed. So always remember this point, guys. A trend is your friend until the end of the trend. Then it's no longer your friend. So emotional attachment can really, really hurt traders when looking to trade the financial markets. So we don't advise emotional attachment in any way, shape or form. Okay guys, In order to summarize, we know that you, as a good trader, has to be a master of many markets and not just one. We need to focus on a niche style of trading across a diversified range of markets. And what we are most concerned about is the following. And this is essentially how we trade. This is our philosophy, so to speak. So our own speciality is sentiment as indicated through commitment as shown through price action. Sounds a bit wordy, but what we're talking about here is also known as order flow. Now, this is the only important part of trading as far as we're concerned. We've educated over 100,000 students who have been through this particular course now, and they don't have, coming into this foundation trading program, they don't have an understanding or a concept of what order flow is. Now, it's crucially important. So we do not gamble here. We trade what has happened. So in a reactive form of analysis, we trade the price of the markets based on the people that actually trade them. So we act accordingly in a very, very simple way. It's all about order flow for us. So it's what the big money is clearly doing is what really excites us, and it's actually what pays our bills and guarantees our profits. So this is the key to trading, and we want to show you basically how to interpret order flow and then how to trade it accordingly. We refer to this concept as counter retail trading, or CRT. Very, very important concept. We do discuss it in lesson 8, so that's a lesson that we would absolutely recommend you tuning in for. So we like to know which group are winning. Is it the long or is it the shorts? So we trade with the winners and we react when the losers fail. So we look for the trades that retail traders do not take. This is what we here at the Academy of Financial Trading is all about. So we are determined to help you profit from the financial markets. So we are looking forward to expanding on how we trade over the next couple of weeks. So please do bear with us. You have a lot of very exciting lessons ahead, and I'm sure you'll all thoroughly enjoy this trading program. Let's draw some conclusions about market analysis. Firstly, are you a trader or are you an investor? Remember fundamentally that cash is king. Fundamental analysis is extremely difficult even for the experts in this particular environment. So some scheduled news announcements create huge explosive moves in the market. So market sentiment is more suitable for shorter term trading. It's not suitable to rely on for longer term trading techniques. This is very important for you guys to understand. So price action can take emotions out of the equation, and it can give us the truest indicator for future price movement. So essentially price action makes it easier to analyze markets, and it makes it easier to come up with a plan for how to react should a certain set of facts start revealing themselves. So the execution part should be almost routine, very easy to do, emotionless and objective. This is essentially how we like to trade the financial markets, guys. So please do take this on board. And finally, most of our time should be spent analyzing and preparing for trading. So let's have a look now at what's up next for you all. So all live lessons are from here on in. So next week you will have 2 lessons on technical analysis. You've got candlesticks, and you've also got a lesson on technical charting 101. So we're now moving into the technical analysis arena, and I'm sure it's what a lot of you have actually been waiting for. So in week 3, just to remind you, you will have actually 3 lessons live with 2 more live lessons in week 4. So lots of exciting and very informative lessons lay ahead. As usual, guys, all webinars are live and recorded and will be available on your members login page on our website. So just before I leave you guys, I just wanted to share a few choice quotes with you from the trading guru Warren Buffett. He's got a lovely big smile on his face there on the screen, and why wouldn't he, being one of the most richest investors in the world and more successful. So the first quote here happens to be my own personal favorite, so please give this some real thought. Rule number 1, never lose money. Rule number 2, never forget rule number 1. very important. Please give it some thought as we move through. Also, a couple of other quotes of his is price is what you pay, value is what you get. So risks come from not knowing what you're doing. Just a couple of little nuggets of very useful information from Warren Buffett. Okay, so listen, thank you very much indeed for bearing with me. I appreciate it was an incredibly heavy lesson. I went through things fairly quickly. I hope you found it somewhat useful. If you do have any questions whatsoever or queries, do give us a call or drop us an email, and your trading support manager will be happy to get back to you as soon as we possibly can. So all that's left for me to say at this particular point, guys, is to thank you very much for joining us, and we look forward to seeing you on lesson 4 of your foundation trading program. So from me and all of us here at the Academy of Financial Trading, bye for now.